Hi, and thanks for joining our new Market Watch series, Tracking the Iran War. I'm Matthew Peter, Chief Economist here at QIC, and today I'll be joined by my colleague Linda Burke, our Senior Economist. Now, 6 weeks ago at the outset of the war, the Economics and Research team here at QIC identified 3 scenarios that we thought global financial markets and the economy could possibly take in response to the Iran conflict. Now, regular readers of our weekly economic brief, which is published on QIC's website, will recognise these scenarios by their names: the benign, the malign, and the malignant. Now, the benign is our best case scenario, our good scenario. In the benign scenario, oil price hovers around the $90 to $100 mark until the Strait of Hormuz reopens, we thought, in around the end of June. And then the price of oil and inflation starts to come down in the second half of the year. The malign is our bad scenario. In the malign scenario, the oil price stays higher for longer. The Strait of Hormuz doesn't open until later in the second half of the year. Oil prices go above $100 and they take longer to come back to their pre-conflict levels. And our last scenario, the malignant, is our ugly scenario. In this scenario, the Straits of Hormuz stay closed for over a year, the oil price stays high, and this is a scenario which we see a recession emerge. We'll be using these 3 scenarios to track the Iran war. Now, currently, we're into our 7th week of the conflict, and it comes off a tumultuous week with the Trump administration's ultimatum to Iran being avoided barely at the 11th hour, and the commencement of peace talks that we've seen over the weekend. So, Linda, what have been the market reactions to the breakdown of the peace talks and President Trump's threat to blockade the Strait of Hormuz?
Yeah, probably not as bad as you would have thought. So there was about an 8% jump in the oil price, and so the Brent crude has moved back above $100 a barrel again. But other markets have been quieter. So like the Asian markets, including Australia, are down. Equity markets are down between 0.5% and 1%. US futures, equity futures are down about 0.7%. And US long bond yields are up about 2 bips, Australia up about 4 or 5. So fairly benign sort of response.
Yeah, particularly given the abject failure of the peace talks. So where does this leave market movement since the start of the conflict?
Well, oil prices are up about 70% so far this year. 45% of that is since the start of the conflict. So there was a bit of a rise before the conflict even started. Equity prices are down, but not by much. At the worst of the conflict, US equity prices were down by about 8%, now only 1 or 2% lower. Australian equities have underperformed the US because our index is more heavily weighted towards mining companies that are big users of fuel. We were down about 9% at the worst point, now down about 3%. Bond markets have factored in higher interest rates, with both Australian and US 10-year bond yields up around 40 basis points since the conflict began. Importantly, though, inflation expectations remain well anchored and close to central bank targets. So fairly good outcomes there. But Matt, how does this translate to how you think we're tracking in terms of our scenarios?
Yes, well, Linda, following the announcement of the ceasefire last week and before the breakdown of the peace talks over the weekend, we were tracking the benign scenario. In that scenario, where we expected oil prices to increase to around $95 a barrel and the straits to be open sometime in June, looked like it had a chance of happening. Up until the weekend, the financial movements, market movements, I should say, were also consistent with our benign scenario, with only a very small decline in equity prices and a very muted rise in bond yields. So in our benign scenario, we thought we were pretty much tracking that scenario prior to the weekend. And as you said, with the market moves since then, we'll wait and see what happens when the US market opens again tonight. But we're still probably, close to that benign scenario. In that scenario, the headline inflation rate, however, was going to be high in the June quarter, around 5%, but we were expecting to fall back over the rest of the year as the oil prices came down. And that meant that the RBA could raise the cash rate just one more time to 4.35% at their May meeting. and then they would be in a position to bring rates down again once inflation had stabilised towards the end of the year. The damage to the economy in our benign scenario was minimal, shaving only 15 basis points off 2026 growth rates.
Well, that doesn't sound too bad, Matt, but the fragility of the ceasefire over the weekend, do you think that suggests we're moving away from that benign, despite the market moves, which have been fairly muted so far? Do you think we're moving away from that?
Well, the problem there is what's happening in the oil price, which is pushed again over $100, and also the fact that we're pushing out when the Strait of Hormuz is likely to open sometime in the second half of the year. Now, the big risk as we move away, as we push out that opening of the Strait of Hormuz and keep the oil price high, which is moving towards our malign scenario, is that it places pressure on prices, not just at the petrol bowser, but throughout the supply chain. There's a risk of inflation becoming more embedded in the economy, and that leads central banks, including the RBA, to raise interest rates even further. So the critical issue really is whether or not those higher oil prices and energy prices translate into inflation across other parts of the economy. So, Linda, I know you and your team have been doing quite a bit of work tracking the inflation rate in Australia. What are you seeing in terms of inflation?
Yeah, you're right, Matt. We have been doing a fair bit of work on it. And as much as I hate to be the bearer of bad news, we're going to be seeing some pretty big inflation numbers in the next little while. So in Australia, for example, headline inflation will be moving above 5% in the June quarter. And that's after allowing for the halving of the fuel excise tax. So it's a pretty hefty outcome.
Yeah.
The bigger risk, like you say, is not actually that headline impact. It's how the price pressures shift through the supply chain of the economy. So economists talk about the second round effects, and what that really is what happens when the higher fuel prices get passed through to the supply chains in the broader economy. Usually these take a while, but we're seeing evidence that this may be happening more quickly than usual. Maybe due to the size and the speed of the shock, it means firms are unable to absorb it into their margins, or perhaps the economy is already operating near full capacity, so it's being passed through fairly quickly at the moment.
Yeah, there's a bit of a convergence of different environments that are forcing a higher inflation rate, not just the shock, but as you say, the fact that we're already operating at full capacity, the inability of businesses to absorb it through the margins. It really puts us in a more susceptible position to having the fuel prices translate into broader prices more generally. Are there any specific sectors that you can see these second round effects already popping up?
Yeah, well, motorists have already faced a price increase of about 40% in unleaded fuel prices at the bowser, but
I
businesses
know that.
yeah, like transport, mining, and agriculture rely more heavily on diesel, and diesel prices have risen by even more than that, about 70% so far. So they're facing a bigger challenge even than consumers. Now, road transport companies have started imposing fuel levies or surcharges in order to remain operational. So it's really eaten into their margins sharply. And
Mm,
Australia's a big country. The increase in freight costs will affect everything that's transported by road.
yeah. Related to that, I suppose, is that sort of big country and the reliance on road transport and whatnot. We hear a lot about the cost of fertiliser and its potential impact on food prices. Is there any evidence of higher food prices yet?
Well, not yet, but on top of the higher diesel prices, farmers are also facing higher prices for fertiliser because most of that comes from the Middle East.
Mm,
So
mm,
they've got two choices. If they buy the fertiliser, their costs increase. But
mm.
without the fertiliser, crop yields fall and they produce less. So either way,
Prices
the
go up
cost of
anyway.
food production, yeah, cost of food
Mm,
production and transport goes up, and it will be passed through the supply chain in the form of higher grocery prices. So some of the surcharges for fuel have already started to come through, but food price increases could have what we're referring to as a long tail, I
mm.
guess.
Yeah, so it can not show up now, but it can they can rise and stay higher for longer.
Yeah, in terms of, underlying ongoing inflationary pressures, and that's what the RBA is going to be looking out for.
Yeah, well, the other sector that we were concerned about, I know, was the building industry and construction costs. Are we seeing evidence of construction costs rising yet?
Absolutely. Petrochemical-based materials like your construction plastics are used for pipes and fittings and drainage, and the prices of those things are going up by around 30%. Firms are being forced to pass on those increased costs and that's pushing up building costs across residential, commercial, and engineering products. So, there's a lot going on in the inflation space, and unfortunately, in the middle of this energy price shock, it's all one way for inflation.
Well, Linda, let's hope those peace talks resume again soon and we'll pull back from the malign towards the benign. On a brighter note, I would say that notwithstanding the disappointing turn of events over the weekend, to date, financial markets are yet to fully price that malign scenario, and we're still a long way off that malignant scenario. Now, that market patience with the situation is going to prove to be critical in keeping the economy from sliding into that recessionary malignant scenario. Well, listen, thanks everyone for tuning in. And Linda and I look forward to our next QIC Market Watch, where we'll continue to track the Iran war.
See you then.